warm welcome to all of you. Over the last 2 years, PMS AIF World has been doing many insightful discussions with eminent fund managers from various funds and trying to bring for the entire ecosystem to learn from the experiences of these fund managers in terms of what lies ahead. We started off, with a very unique series by name Crystal Gazing Next Decade of Wealth Creation for Investors, and that has been very, very successful. And as a part of this, we have done many webinars, and investors, advisors who come to our platform have been asking us and have been appreciating us for all the work that we have been doing. And of late, they have been asking us now, markets have reached to kind of a very high valuations, levels which were unimaginable. What lies ahead? What is ahead? How to make money further from these levels? Also, we have been seeing, based on our interaction with various fund managers, that valuations have always been bothering many investors as well as advisors. Today, many people are sitting on liquidity, are sitting maybe, a debt skewed asset allocation because valuations are something which they don't understand and which logically don't, make sense to them, which is well understood. These valuations at one point of time, we know when markets are bearish and market sentiments are bad, have become very cheap. We have seen times when price to earning multiple, which is a very simple multiple, had come down to levels of 10, 12 also. And today, when they are very high, 35 to 40, so that also kind of keeps everybody, very, very confused. So one simple answer to that is that, it is basically what investor is chasing. Where there is demand, there is valuation. And that exactly, what brings us to bringing the context of this webinar, that what lies ahead and what is the consumer behavior talking about. Over the last 2 years, we have seen, all over the world, the level of sensitivity amongst human beings have gone up. And that has gone up because we have seen so terrible times amongst ourselves. COVID has devastated all of us. And the level of emotions, the level of fear, the level of stress that we have seen, was never ever thought of. And this is one of the events. But before that, because this event has kind of made an impact to human beings. That is why we have kind of witnessed it. But otherwise, we have always been talking about the literate part of our ecosystem, which is what you and I represent, and we have hence responsibility and ownership that environment, society, and corporate governance are something which are very, very important. And coming back to the point which I was trying to make, because now we are all the more sensitive after COVID, the demand is going to come to this segment. All over the developed part of the world, we have seen ESG, which is environment, society, and corporate governance, becoming pillars for many fund managers, and hence money moving towards them. In India also, there have been, many successful asset management companies which have realized it sooner than later, and that is why they have launched some of these funds. And in that regards, I Avendus, which is a fund house well known for alternates, have launched a PMS. It's already more than 6 months that they have been running it very successfully. And Mr. Abhay Laijawala is the fund manager who represents this particular portfolio management service. I'll spend 1 more minute on Abhay and then we'll start this discussion. Abhay Laijawala brings with him more than 25 years of experience. He has been working with Avendus Capital for last more than 2 years. He joined Avendus in 2018 and he is working there as managing director and fund manager. Before 2018, for 10 years, he has been head of research, managing 120 stocks as his forte at Deutsche Bank. And, before that, he has been otherwise a veteran for capital markets, where he has seen capital markets evolving, from the eras of liberalization till date. We are here to learn from him and understand from him, what is ESG as a framework and what lies ahead. Why do we say that ESG is a way and method through which clean and right way of wealth management can happen, and we can see, wealth creation happening in this way. Over to you, Abhay, and very warm welcome to you. Before I start asking you, questions that I have noted down for you, you can give your introduction yourself and maybe, explain about ESG and your thought process, and then we'll start.
Sure. First of all, Kamal, thank you very much for giving us this opportunity to present something that we are extremely passionate about. When we started looking at ESG in February of 2019, it was a very new concept in India. And in the 2 years since then, 2.5 years since then, we've really honed our approach, and we have learned a lot. So just to make it very simple, the first thing I wanted to tell your viewers is ESG should not be seen as any kind of scientific, is it an art, is it a science? ESG is primarily a style of investment. The way you have value, the way you have growth, you now have ESG. And the reason, what the difference between the ESG style of investing is that it takes into consideration the factors that go beyond the traditional financial factors. So this is a 360-degree analysis, which goes beyond the financial factors. It goes into the, apart from the evaluation of the balance sheet and the financial statements, it actually goes into the relationship that a company has with all its stakeholders. So a company works with the regulator, a company has a relationship with the employees that work for the company works in a certain society, and the company obviously has a relationship to its shareholders. So earlier, when we looked at traditional financial analysis, we looked at a company and its relationship with the shareholders, where profit maximization was seen as the primary objective. Shareholder return, maximization of shareholder return was the key criteria for company boards. But that entire definition has now changed. And a company is now being evaluated not just on shareholder returns, but on stakeholder returns. And this pretty much has arisen because the definition of a company has changed. Earlier, as I said, the objective of a company, the purpose was to generate a profit. The new objectives in the environment we are in talk about profits, but with a purpose. Are you taking all stakeholders with you? So in conclusion, what I will say is that ESG is a style of investing, and the objective is to be able to assess risks as well as opportunities, which go far beyond the financial factors.
Sure. So, I'll quickly give one disclaimer that we will try to interact from the perspective of investors to make it very real, so that most of their questions that would come to their mind are answered.
Of course.
And so the first question that comes to my mind is that in general thinking, when we are saying a company which is compliant to all ecosystem, not only focusing on profitability, would generally be a company which is a well-established business. Maybe, which is a large business in terms of market cap. Am I correct in my thinking, or because you have deep dive this?
Could you say that again? I didn't get the question.
I'm saying, when you are saying that ESG is different from the traditional way of picking companies, is because you're not just focusing on the profitability.
Yes.
You're focusing on the overall, stakeholders in term which are part of doing the entire business.
Yeah.
So for a company which is small size company or a mid size company, right, for it to not focus on profitability and focus on a lot of other measures which are linked to giving back to the society, right, are maybe less important. For a company which is a large size, is already an established business, it is obviously important for them because they are more seen from that perspective. But at the same time, investor thinks that a large company gives him lesser kind of investable sense in terms of making money, right? What is your answer to this regards?
No, the answer is that large or small, every company has to look in the new environment that we are in large or small, every company needs to look at the stakeholder perspective. So you say, let's take, for example, it's a small company, and while it is making a profit, there are the other variables that investors will look at. What is the level of corporate governance at that company? How is that small company also treating its employees? How is that small company behaving at the environmental level? What is its pollution track record? What is it doing in terms of helping its employees? So honestly, it doesn't matter. And I think the point I'm trying to make over here is that profits in its absolute sense is no longer the way a company will be evaluated by shareholders. And when a company focuses on these extra factors, such as does the company has had any accident in terms of environmentally, in terms of a leak, or in terms of some chemical leaking if it's a chemical company, or if it's got some effluents, has it been involved with the regulatory authorities in terms of effluents not being controlled, how much water it is drawing from the water basin. So all of this eventually goes in the profitability as well. So answer to your question is, large or small, every company will need to embrace these extra factors. And now I'd like to add over here that recently the SEBI has come out with these BRSR norms. This is a very, very detailed level of disclosure around the ESG factors. And these are not just for the large companies. These are for the top 1,000 companies. So large or small does not matter. It is equivalent to all. And in fact, I would actually urge the smaller companies to embrace sustainability, because that's how a smaller company will be recognized even more by shareholders. And if a smaller company is able to show and demonstrate that it is going to move up on the sustainability parameters, it has a well-articulated sustainable strategy, etc., I can assure you that that company will be re-rated and receive a higher valuation than many of its peers. Because that's what investors want. They want companies that are resilient to risks.
Sure. So, the next question that comes to my mind is that, is your portfolio also having any limitation with regards to, sector bias? Because, there could be certain sectors which could be very attractive for India in terms of India's dynamics, and it could be rightly poised in terms of timing. But because, you have to follow ESG and those sectors kind of do not demand that, will your selection of stocks be limited because of that?
Sure. No, very good question. Now, let me answer this question saying that for ESG to be truly effective, you have to assess the materiality component. Because if you are, having a certain method of ESG, for it to be effective, you have to define what exactly you are doing. Therefore, what I'm going to say is that what may be ESG material for India may be very different from what may be ESG material for the United States or a Korea or a Japan. So what we do at Avendus is we have identified, and I think, can we put up that slide? We have a slide which talks about the ESG, what we've identified as the key ESG material factors for India. Maybe if we can put up that slide. No, if you can go back. No, keep going back. It's at the beginning. Yes. So what we have done is we have identified 3 to 5 variables that our fund will focus on, in addition to other factors, far more on these, because these are some of the identified ESG issues for India. I won't go into the details. They are water crisis, air pollution, carbon emission, and of course, we have cyber security, which is not listed over here. But as India digitizes, we see that being a very, very material ESG factor. So what we therefore do in our process is that given that air pollution and carbon emissions are identified ESG issues for the country, we have an exclusion policy taking into consideration these two key ESG issues, and therefore we will exclude all fossil fuels out of our portfolio. We will not invest in oil, in gas, in coal. We will not invest in any of these companies, and that stems from that because we see a very high risk of either penalties or we see a global regulation which could potentially result in the fossil fuels sector coming under severe duress and get derated. So we exclude fossil fuels, we exclude tobacco, we exclude weapons, and we exclude alcohol. So these are the exclusions. Other than this, we will look at all the other sectors, but I hope I have been able to explain the reasons why we have these exclusions. It is keeping in mind the materiality of these factors for India, air pollution and carbon emission, and you are going to see a lot of action on both pollution and carbon emission from the government and from international regulators as well. And therefore, we believe that the exclusion could itself become a source of alpha creation.
Right. Now, for further understanding of our viewers, since you have been deep diving this subject, and let me give this disclaimer to our audience that we may be discussing some names of some of the stocks that may be held by Avendus Portfolio Management Service, and the idea is not to give any kind of advice here. It should not be construed as any kind of advice. This is only for education. Right, Abhay. So, if you could just guide us, I can recall of two stocks that come to my mind, which is ITC and United Beverages. Right, as a common man, these two stocks hit my mind, which are clearly no from the perspective of the meaning of ESG, the way you have explained.
Yes.
Right?
Yes.
Can you share more names which are exclusions, which are popular otherwise stocks, popular companies, but are clearly no, so that audience gets an understanding.
Sure. So ITC, United Breweries, these are there. In addition, I think Coal India at this point in time, I think that's a reasonably popular stock, given that there is a lot of interest in PSU companies. But unfortunately, Coal India is fossil fuels, so that is excluded. Similarly, we won't invest in a BHEL as well, because BHEL is into thermal power equipment manufacturing. We also, at this point in time, do not have an investment in Larsen & Toubro, but it seems that Larsen & Toubro is making some clarifications on weapons. So that has become gray. We are still awaiting more disclosures, but until those disclosures from Larsen come in, that is a popular stock, but that's excluded as well. So these would be some of the exclusions. And of course, Reliance. I think that's one of the most popular stocks, and you might wonder that are you going to be able to, how are you going to generate alpha if you don't have Reliance in your portfolio? Answer to that question is until Reliance has hived off the O2C business, and we have becomes uninvestable for us. But we could easily invest in Reliance Jio or in Reliance Retail should they be completely separate entities.
Right. So, let's now talk from, investors' perspective again, taking it ahead. There are two types of investors. One, those types of investors who are spiritually savvy. And, those investors would say, I would clearly say no to some of those businesses, which are not adding value to the ecosystem. Right. I can tell you, we come across, these types of investors also. And obviously, these are rare investors, because the sensitivity level of we as literate audience, who are more of chasing money, is gradually going up, right? And there are other set of investors which are actually large, which I would say are 90%, which are not spiritually savvy, but they are basically trying to chase money, right? Now, from those set of investors, which is 90%, whether investing in ESG or not investing in ESG does not matter, because their ultimate objective is money, where they make more money. Now, if those set of investors ignore ESG by saying that I am not spiritually savvy, to me it does not matter how you make money, but to me it matters what is the quantum of money I make. What is it that those investors are missing by ignoring ESG in their portfolio?
I think they're missing, some of the biggest outperformance over the next couple of years. And to be able to answer this question, let's go to the slide once again. We have a slide on what are the current risks and what are going to be the future risks that investors will have to watch out for. If we could go to those slides, keep going page down. I guess it's towards the end. I think towards the end. I think it's probably the last slide. Yes. So to answer your question, let's look at this screen. What we are highlighting over here is up until now. So I put that into current risks. When we've really looked at large financial events and what has really impacted financial markets, these have been the key issues. What you see on the left-hand side: trade wars, energy price shock. We've had the banking crisis, which was a global financial crisis. We had the commodity cycle boom and bust. We had the European periphery crisis. We had the dot-com boom and bust. All of those were financial events. Now, for a minute, let's move to the right-hand side of the screen. What are some of the future risks that investors will need to be extremely wary of? And the reason I put these risks here is, these are going to be very significant risks. So what are going to be those risks? Water stress, inflation and income inequality, extreme weather, the global pandemic, environmental disclosures. So I could go on and on and on. The point I want to make is that the world as we see over the next 5 years, 10 years, 20 years, and 30 years is going to be dramatically different, with a very accelerated pace of change. And many of these risks that we've highlighted on the right-hand side are physical risks, but these physical risks are going to be financially very material. Now, let's take the example of the pandemic itself. The pandemic is a physical risk, but this physical risk has been a far bigger source of financial market turmoil than even the global financial crisis, which we had 10 years ago, which was a financial event. So the point I'm trying to make over here is that you don't need to be, doing a social impact to be investing in ESG. You are investing in ESG because ESG is going to be the best strategy that captures the risks and opportunities that you see on the right-hand side of this screen. Now, you tell me, and I think all your viewers, I want them to think right now that if you were to apply your traditional financial mindsets and the way we've been looking at companies all these years, would we be able to assess these risks which are there on the right-hand side. Now, you could tell me, but aren't these just academic? How are they? How can you quantify this? I'll give you an example. Look at what is happening to food prices as we talk. World food prices are moving higher and higher and higher. And one of the reasons for that is climate change. As a result of this climate change phenomenon, we are beginning to see that impact food production. What we are seeing in terms of extreme weather, there is more and more and more evidence which is demonstrating that global GDP growth could be impacted by as much as 6% per annum on account of severe climate factors. In fact, there's a lot of study. One study came out today itself. So I won't go into those details, but the point I'm trying to make is that ESG allows you, because of the 360-degree analysis, it allows you to take into consideration not just the traditional financial risks and the opportunities that are, but at the same time, the risks and opportunities that are going to arise in future, which go beyond the traditional financial risks. So I think this is what I think is very, very important. ESG is not, 10 years ago, we had ESG, which was more of an impact investment strategy. You invested in ESG because you wanted to deliver an impact. But today, ESG is a source of alpha creation. And this source of alpha creation will become even more solid as many of these risks and opportunities that you see on the right-hand side come to the fore. And if you are not assessing these risks and opportunities, I think you could see a severe derating of your portfolio.
Sure. So at the moment, like you said that SEBI, which is the regulatory body, enhance the importance of following ESG. Do you also see, the way stocks are added in Nifty, there are also things like ESG becoming one of the important parameters in line, apart from the other factors which are taken care by NSE while they construct this index, which we call as Nifty.
Yeah, but we do have, Nifty has an ESG index, right? So they have a separate ESG index. So I think that's a very good move because this way the Nifty is also giving a choice to investors that we, apart from the Nifty, we also have a Nifty ESG index where you have companies that the Nifty believe are high on sustainability criteria. So every arm of the regulator is moving in that direction. SEBI is moving from the business responsibility reports to the BRSR. We have Nifty coming out with these indices. And I think a lot more will come through. The way we are seeing regulation all over the world, I think you are going to see massive focus on ESG factors all over the world in terms of regulation, led by Europe and the United States. And countries like India will be following very, very fast.
Right. So we have more or less covered, what is ESG and, why ESG is important. Now I want you to cover, then within ESG, for example, we have identified IT sector as one of the sectors which is ESG compliant. Now there are, 4 companies in IT sector, all of us understand, like, starting with Infosys, then TCS, then Tech Mahindra, and then HCL, right?
Yeah.
So I do not know, what companies are there in your portfolio, right? But how would you, go and take next step and identifying, what out of these 4 companies you would want to add to your portfolio? And maybe if, you say that all 4 are in your portfolio, obviously weights would be different, right? So how would you assign those weights?
Sure. So in our portfolio right now, in the ESG portfolio, we have Infosys, we have TCS, we have Tech Mahindra, and we have HCL. Now, almost all these companies rank very high on ESG, and let me give you a couple of examples. So first of all, many of these companies have stated that they want to become carbon neutral by 2050. Now, for an IT company, that's not such a big thing, but it is a great initiative. Apart from that, TCS. Let's take the example of TCS. Now, TCS has got a very conscious strategy on encouraging gender diversity. So what they have said is, and this happened even before the pandemic, they had said that they have a very high amount of women employees at the entry end. And then, as time passes, the women workforce, the female workforce tends to move on, maybe on account of, responsibilities, marriage, etc. And therefore, they say that once you move to the mid-level and the senior levels, the proportion of women in the workforce comes down dramatically. So what TCS has therefore done very consciously 2 or 3 years ago is they had encouraged flexible working from home strategies. And they were going to many of their former lady employees and saying that we are going to give you an opportunity to work from home. Please come and work for us. And as a result of that, as I said, even before the pandemic, they were able to get many of these senior lady employees back into the fold. So we thought that this was a very good strategy in terms of encouraging more gender diversity in the workforce. And at the same time, it encourages loyalty, it improves productivity. It has a lot of tangible, not just intangible, a lot of tangible benefits on the overall working of the company. It gives you happy employees, it gives you productive employees, it gives you experienced people, it reduces the attrition rate. So these were some of the examples. So this is the TCS example. I think similarly I could go on. I think all the IT companies in that sense are very similar, and many of these IT companies obviously because it's IT, you don't have to worry about carbon as well. So in that sense, they would automatically rank very high on overall ESG criteria. And each and every one of these companies has very responsible boards. And I think here I would say there is no distinction between an Infosys and the TCS in terms of governance, in terms of boards, in terms of independence of boards, audit committees. So these are some of the examples which lead us to have almost 4 IT companies in the portfolio. Now, as far as the weights go, remember the objective of an ESG fund is alpha creation together with obviously delivering the sustainable impact. So you've got to merge the financial and the ESG factors. So our weightage is determined, apart from the ESG factors, through the financial factors as well. So the valuation of the company, the earnings profile, and therefore the valuation is a function of both ESG and the financial parameters. So we might probably have one company that is ranked higher, one company that has a higher allocation in the portfolio, and that could be on account of where the valuation of the company is at that point in time, what is the earnings profile, etc., and not just the ESG factors. Because as I keep repeating, and I will throughout this session, to say that the objective of ESG or integrated ESG style of investment is to generate a sustainable alpha.
That's exactly the topic of our discussion today, and we also believe in that. But somehow, let me tell you, the real feedback, most investors of late, have started to understand ESG because the level of sensitivity has definitely increased after COVID. But 1 year ago, if we have done this discussion, many investors and advisors would shun it by saying it's just a marketing gimmick. It's just a marketing pitch, in terms of we using ESG and somebody else is using QGLP and like that, right? But yes, I realize that, the more there is a demand for a particular style of investing and a particular type of businesses, the valuations of those businesses can keep going up because there is a demand, and we have seen that. And let me tell you, I had run a poll asking the audience that, would you want to invest into ESG portfolio or not? 81% people have said yes. And then
I'm very happy to hear that.
Yeah. And then I ran a subsequent poll, which, I wanted to understand their level of conviction, which the question was, I believe ESG can generate alpha over long-term portfolio. And then here also 80% people have said yes.
I'm impressed. I must say that investors are very, very savvy. So it's so new to India, but yet they have pretty much identified the right spots of ESG investing.
Right. And let me tell you, we as a platform, PMS AIF World, have actually built a very right and fine name in the industry of alternates. And that is why our audience is actually HNIs and ultra HNIs, and they understand and appreciate good work and good things. Now coming back to the
very happy to hear that.
Thank you. Coming back to the older question that we were discussing about the IT sector. Now within IT sector, there are certain modern businesses which are called platform businesses. I'll give you an example. InfoEdge is one of the examples. India Mart is the second example, and likewise. And maybe in terms of I would say overseas businesses, Google, Facebook, there are many such examples, right? So the question has two parts to it. First of all, does platform businesses in Indian context qualify for ESG or not? And secondly, if you were to select any foreign offshore IT business in your portfolio, would that also qualify as ESG?
So the answer to your first question is, one or two of the stocks that you mentioned. Now, I haven't looked in very great detail at those companies, but on the overall platform level, I would imagine that they would qualify for ESG, that they are helping in democratizing data and in bringing the small and medium enterprises onto the main platform. So in that sense, they are delivering a very positive impact because they are actually giving many of these SMEs a platform to come in, a business-to-business kind of a network. But to be very honest with you, as I have not looked at those companies in details in terms of the governance, in terms of the boards, I haven't done all that analysis. I really would not be able to tell you if those companies, where they would rank. Because just to give you an illustration and ESG analysis, we look at close to almost 150 to 200 variables. So it's a very, very detailed process which goes into the nitty-gritty of every company's, the E, the S, and the G, and the purpose behind the company's ultimate sustainability initiative. So on the whole, larger picture, I think they definitely would because of what they do in terms of bringing the SMEs onto a national platform and encouraging the democratization of business. But on the specific details, I'm not aware, so I won't be able to comment. And sorry, on the global, what was your question on that?
So companies like Twitter, companies like WhatsApp, businesses like WhatsApp, Facebook, Google.
Yes.
So how do you view these?
Those are fine. No, those are fine. You will see in most of the ESG funds globally, you will see Google, you will see Facebook, etc. The only thing now we'll have to see what happens with this taxation, etc., that the Biden administration is imposing. What happens in terms of the legal ramifications? I think those are issues we'll have to see. But at this point in time, you will find many of these companies in most ESG funds because these are all well-ranked ESG companies, and which are the companies themselves are extremely ESG conscious. So it's a symbiotic relationship. The company delivers a purpose, and the company itself is very ESG focused.
Right. The sector which is heaviest, with regards to indices is financial services. Now let's talk about that sector. Within financial services, how would you differentiate, using your ESG framework between companies like HDFC Bank, ICICI Bank, and SBI?
Sure. So I think we have some slides on this. Maybe we can take a look at those slides. We have in our approach, we have some questions as illustrations on what we look at as far as banks are concerned. If you could bring those up. Kamal, I can't hear you.
I'm saying the PPT, is not there because it got locked out in between.
No worries.
I'll add that. You can continue. I'll add that.
Sure. No worries. So this is a very good question that you asked. Look, when we are analyzing a bank, an Indian bank, we look at, I'll give you the examples of what we look at. So say, for example, we are looking at the E part of it. Now, if it is a corporate bank, then we will look at the bank's breakup of who it has extended the loans to. What is the exposure to environmentally negative sectors, such as coal, etc. And within the coal sector, if there has been any lending, then we look at what was done to analyze this particular investment. Did you do an impact assessment report? Did you look at the pollution studies? Did you look at effluent controls? Did you look at how the fly ash is being evacuated, etc.? Because the objective is to ensure that this particular environmentally sensitive industry does not fall foul with the regulators, which could probably result in either penalties or, if you lend to a plant which happens to be close to municipal limits, what if pollution levels increase and the plant is at risk of a shutdown, etc. The other thing we will also look at is, let's take the example of the coastal road. And I think this is an example I've been giving because it's a very recent example. If a bank is lending to an entity which is building a coastal road, in Bombay, then we will look at data such as, did that bank do an impact assessment report of their own, which analyzed sea levels or tide levels. And given that all the science is showing that sea level rises are going to be a phenomenon that we will all have to live with, we will ask if the impact assessment report has analyzed the tide levels for the next 50 and 100 years. And if, for example, the impact assessment report says that they've looked at tides, but for the last 50 and 100 years, that would be a red flag for us, because then there is a very, very high possibility that in 10 years from now, on many days of the year, this particular coastal road will be in water. So this is just an example. So this is on the E part. On the S part, what we look out for is cybersecurity. Now, in India too, we are hearing of more and more incidents of cybercrime, etc. So, we are all aware of cyber, but let me tell you, for a bank, it would be horrendous if it became a source of a cyber attack and customer details are compromised. So we look at that very closely. We have a whole process where we will look at a bank's cybersecurity policy. We will look at what is the kind of training, who is in charge of cybersecurity, etc. And trust me, when we go through the data, we are able to assess which bank is focused on cybersecurity, and cybersecurity is in the DNA of this bank. I'll give you one more example. Recently, we met up with the CEO of a top 3 Indian bank. I won't go into the details. I won't say private, public. I will let the viewers guess the name. The CEO of a top 3 Indian bank. And after all the question and answers were over, at the end, I asked him this question. What are your views on cybersecurity, and is cyber risk something that concerns you as CEO? And the CEO looks at me and says that it is not NPL's asset quality that I, at my level, am really worried about, because we think that we sorted out those issues. But what puts me up at night is the worry that someday there could be a cyber attack on the bank. Now, this to me was extremely comforting, because obviously, if there is a cyber attack, it's very difficult, to predict one. But if at the CEO level, this bank is concerned about cyber risk, then that bank will have a process. It is receiving attention of a key ESG factor from the top level. And sure enough, therefore, God forbid, if there is a cyber attack on that bank, because of the focus, the bank will be probably able to mitigate this much more than another bank where this particular issue is not receiving the attention from the top, from the CEO, from the board, etc. So another example of what we do. And trust me, in many of these future risks and opportunities, it is going to be high tide levels, the example of which I gave, cyber risk, which I'm talking about. And I think these will be sources of valuation, re-rating, and de-rating. If you have a bank which has been a source of a cyber attack, information has been compromised, and the bank has not had a process, is not able to blunt the damage, can you imagine how severe the risk of a de-rating can be? So these are the issues that we look at. And of course, as far as employees is concerned, this would be generic to a bank or to any company. We will look at, apart from other issues such as gender diversity, we will look at what is the level of satisfaction of the employees, what is the attrition rate, does the company have a whistleblower policy, does the company have employee surveys, etc., etc. So these are some of the examples. On the S part, it is common everywhere, but I think the 2 examples that I want to particularly allude to were on what we do on the E side and what we do on issues such as cyber security. I think one of the Indian banks is currently under pressure, and I won't name that bank. It is a very large bank, and that bank has some green bonds, and some of the global ESG investors are threatening to jettison those green bonds because that bank has lent or is looking to lend to a highly controversial project in Australia, which every environmental group in the world believes is going to be a source of massive risk to the Great Barrier Reef. So these are examples, and that bank is currently contemplating, and one hears that they may probably change their mind on whether they're going to lend to this controversial project or not.
Quite insightful, I must say. Another question, that has been asked by someone from the audience is that in India, though we know that ESG is a new concept, and we cannot say, that large percentage of funds are controlled by ESG framework, but what has been otherwise, the composition of ESG form of fund management versus traditional form of fund management internationally?
I'm sorry, you'll have to explain the
So
question.
basically, in Indian context, right? So there are
Yes.
4 or 5 funds, couple of mutual funds, and 1 or 2 portfolio management services I am aware of that follow, ESG as a style of investing, right? And if I add together their AUM, it will be in total maybe 10,000 crores.
Yes, yes.
Industry which is 30 lakh crore, around 30 trillion in size. 10,000 crore is very very low number. But obviously this over a period of time will change. Now, in terms of percentage, I would say that in Indian context it is negligible. But let's talk about beyond India. Let's talk about developed part of the world, right? So say US, Europe. So what can you do? You have any data to support to convey that in India also we will see large corpus of funds moving towards ESG?
Sure. So globally, between 2011-12, when ESG started becoming popular, we have the latest data from the Global Sustainable Investment Alliance for 2018, and that data is putting, the total value of ESG investments at close to around 30 trillion, which is almost which is a very very high figure, 35-40% of total assets under management. And this is 2018 data. I'm very very certain, based on the amount of inflows we have seen into ESG in 2019 and 20, particularly after the pandemic, that when the next data comes out, and I'm not exaggerating when I say that the total AUMs could probably be twice that figure. Because after the pandemic, we've seen a lot of inflows into ESG funds globally. In fact, a lot of funds are repurposing themselves as ESG in the Western world, because close to 40-50% of all inflows are going into ESG funds. Now, coming specifically to India, the way I'd like to answer your question is 2 years ago, when we had nothing in ESG, would you have thought that within 24 months, as much as 10,000 crores will be the assets under management in ESG funds? So I think that is kind of making the point that as ESG is going mainstream in the world, it is also being embraced by Indian investors. Now, in many ways, the companies today in India are already reacting to ESG, because the foreign institutional investors have all signed on to ESG mandates, and therefore you're already beginning to see a re-rating and a de-rating. Companies that rank high, or companies that are perceived to be high on sustainability and ESG parameters, tend to trade at higher valuations. And I think you yourself took the example of a certain tobacco company, how that tobacco company, is excluded from ESG funds. And just look at that particular company. 2 years, 3 years ago, we had that company and another leading FMCG company trade at roughly the same valuations. But today, that tobacco company trades at 25, 27 times 1 year forward, whereas that particular FMCG company trades at almost twice the valuations. So the point I'm trying to make is that the Indian investor is already beginning to see the valuation re-rating and de-rating. And now the Indian investor is getting an opportunity, because earlier an Indian investor, if he wanted to go to ESG, he had to go and invest in an ESG fund, in an ESG international fund. Now those options were not very easy. You have to take all sorts of, LRS, RBI approvals, etc. But now the Indian investor who's watching what's happening all over the world, is watching the alpha creation, is getting an opportunity to invest in an ESG strategy. And therefore, I have no reason to believe why ESG will not go mainstream in India. I'm very, very confident that with every stakeholder in India coming together on ESG, you are going to see ESG going mainstream in the country as well.
Sure.
Because that will be the way to generate alpha. That's all I'm saying. You're not, I'm repeating again, you're not investing in ESG to deliver a sustainable impact. While delivering a sustainable impact, you are also creating alpha. And therefore, that's the reason that is going to drive ESG moving forward. It is not altruism. It is alpha generation. And I want to make it very, very clear to your readers, to your viewers, that ESG is not about altruism. It is not about changing the world. It is about changing the world in a positive way, but it is the only way moving forward in which alpha will be created.
Right. So you have rightly put this word. It's not only about altruism, and again, this is the last question, which brings me to the end. So I'll just recap. We have discussed, what is ESG. We have discussed why ESG. We have discussed what is the importance of ESG, and what one loses or what one misses if one ignores ESG. And we have concluded it is the way to generate alpha. It's not only about altruism. Now, because ESG is growing, it's important. There are a lot of companies, a lot of funds, within mutual fund structure as well as PMS structure, which are following ESG as a framework, right? And apart from ESG, there are a lot of other types of funds that may not purely follow ESG, but they may follow, they may read parameters which are financial parameters in different manners. Somebody would say that we would give more importance to volume growth. Somebody would say that we give more importance to valuations as well as the expected earnings. Someone would say that we give immense importance only and only to valuations, right? So likewise, every fund manager have their own style of investing, and because the markets are the way markets are buoyant currently, I would say that every fund manager is having a good time. But in long-term context, maybe I believe that ESG as a framework would have a sustainably good time. However, now within this ESG as a style of investing, right, how would you differentiate, right, the financial part of selecting a business? You have identified sectors, you have a list of do's and don'ts, right? Within do's, right, how are you different from, for example, somebody else? Could be Kotak Asset Management, could be Mirai, right? They also have their ESG funds. How are you different in terms of financial aspect of understanding the businesses? And maybe your allocations to businesses will be larger, right? So they would follow more diversified approach. You would follow more focused approach. And before that, once you have identified a company, right, you may want to hold it, and your time of exiting would be different. So there are various aspects that you could cover, but I want to understand from you. This is the last question, and then we will wind up.
Sure. So what we are doing at Avendus is we are following the integrated ESG style of investing. And when I say integrated style of ESG investing, it primarily means the explicit integration of ESG factors into our fundamental analysis. So what we will do is we will obviously have a model, and at the sales level, at the cost level, etc., we will integrate the ESG parameters, and then we will come to our financial analysis, the sales, the EBITDA, and the net profit. And then many times we see that when you integrate these ESG risks and opportunities, the integrated number of the profit, when you've integrated financial and ESG factors, is very, very different from what you see in the traditional financial approach. So that is one thing I want to say we do. I won't go into the specifics, but I will give you one example. Given that air pollution and carbon are very important and identified material risk factors for India, we are very convinced that the regulator is going to be compelled to act on pollution. You've seen what has happened in China, how China has been forced to act. And finally, the governments act when the social disturbance on a certain issue reaches such a decibel level that the government is forced to act. And we think that we are reaching that level as far as pollution is concerned. So when we integrate pollution at the sales level, for an auto company, for example, we will look at an auto company from the perspective of the fuel mix, because until you have an articulated electric vehicle strategy, you either have diesel or you have petrol. Now, say, for example, in your financial modeling, you have built a certain model, but one particular company seems to be overwhelmingly having a reliance on the diesel engine technology. So they don't have a petrol variant, or they don't have an established petrol variant. Then given this pollution risk, given this particular risk of likely government regulation, we actually tweak the sales line and the cost line to take into consideration what could be the potential penalties, what will be the impact in terms of consumer preferences on diesel vehicles versus a petrol vehicle. And trust me, you come up with a very different number, because your whole sales number and your cost line tends to get impacted when you bring in this into consideration. So this is something, that we do. I wanted to bring that as an illustration. The other thing that we think we are doing differently, because I haven't seen the others disclose this variable, is at Avendus, we are disclosing the carbon footprint of our portfolio. Because given the vulnerability of climate change to a country like India, and I won't go into the details, we believe that an investor in an ESG fund has the right to know what he is doing, because this is an ESG fund. It is not a traditional fund. And given the climate vulnerability factors, an investor coming into an ESG fund must know what is the carbon footprint of the portfolio he is investing in. Because if you have the carbon related risks, if you're going to have, with Biden and with Europe talking about decarbonization, carbon taxes, you're going to see a very, very severe derating of, companies that are very high in carbon. So at Avendus, we are disclosing our carbon footprint. And we think that, all ESG funds should actually be doing so. And what we would like to do is, given the importance of carbon and the sensitivity of carbon to a country like India, the carbon footprint of our portfolio will be lower than the carbon footprint of the corresponding Nifty index. I'm referring to the Nifty because our benchmark is the Nifty. It is not the Nifty ESG index. And the reason for keeping the Nifty as a benchmark is because we want to prove that ESG is not some niche strategy. You will outperform your benchmarks, and therefore our benchmark is the Nifty and not the Nifty ESG. So I hope, I've been able to give you some illustrations of what we do that is different. And, the very, very detailed approach, trust me, it's a very, very long and detailed approach that ultimately results. And many companies that rank very high on ESG rankings, when we do the final analysis, they become uninvestable for us because of the ESG factors. So we go far beyond the rankings. We won't just look at, the rankings and say this company is ranked very high on ESG. Now let's, look at the financial parameters and see whether it's investable or not. This particular auto company is very highly ranked on ESG, but it didn't make it to our portfolio because of this integration of the diesel risk.
Right. So your portfolio is in front of me. Somehow we are just reaching the end, and I cannot disclose the portfolio, but because I can see it, I can tell you it is making a very, very good sense, right? And I absolutely appreciate you explaining it in so detail that why ESG is not only about altruism, it's about alpha. And that is the reality, and that is the way forward, and that is the crux, and that is the message I want to leave my audience with. Thank you so much, Abhay, for your time, and thank you everyone for logging in. We'll be back soon with a similar educative webinar. Goodbye.
Thank you very much. Thank you. It was a very good discussion. Bye-bye.
Pleasure.